So welcome to the market recap. We're going to go over all the trades we've taken this week, and we're going to break them down fully from the very entry point that we got in to where we got out, and the whole thought process going through all the trades. And we're also going to go over some trades that we actually look to hopefully be trading before the end of the week, this coming Thursday and Friday. So everybody will fully understand all the trades that we have planned, and then why we are actually planning to stay out of some trades. So let's just talk about the ones that we've actually entered. So for the week, we're currently at 6.2% profit, with 2 losses and 2 wins. So let's break down Euro GBP first. That was actually quite a good trade, and we'll break down exactly where we got in, where we got out. But unfortunately, it looks like it's still going to go up towards our take profit, but we actually did get out this trade for roughly 4.7%. So again, great trade. We got in at a really nice entry. Of course, the stop loss was nicely out the way. We marked out the charts pretty much perfectly here. But again, let's just break down why we actually got in this trade to start with. So if we go all the way back to the daily, what really attracts this type of trade is this big massive push phase in a bullish fashion, right? So you can see that we've broken this high back in the 23rd of March, around about 23rd, 24th, 25th. All of these highs collectively we have broken up, and we've broken up quite convincingly. Then what happened, we actually respected the break, and then we've come back down into retest. Now if we throw a Fibonacci on this low here to the tops of these highs, because this is the push phase, we can sort of work out where a good level of support would be to come back down and retest. But what the market's actually done is it's gave us a level, and that's where we took our trade from. So again, a little bit hard to see on the daily, but if you go down to the 4 hour time frame, you can see it makes perfect sense. We've had good touches to the left, and of course even recent. So we need to make sure that the price action is actually being affected recently. As you can see here, we have been affected recently. We had this, one could argue this could be an inverse head and shoulder. We had the left shoulder here, we've had the head, we had a massive rejection, pushed back up. It's a great sign that we should be taking off. I'd imagine many people would have got in buy positions here, but again, you can see we had that double top, and we've been rejected quite heavily to have technically what you could argue again is the second bottom to the double bottom, this being the first bottom and this being the second bottom on this support zone. And then the key rules for double bottoms is make sure there's space to the left, and of course this bottom, depending on if it's in an uptrend or a downtrend. Obviously we are in a downtrend and we've had a double bottom, hence why it's called a bottom. The second bottom ideally should be slightly higher than the first bottom. So this gives us a good understanding that the market is likely to push up from here, and unfortunately we're out of this trade now. We just took our profits while we could. Markets were starting to get a little bit erratic, a little bit indecisive, so we took profits probably a little bit too early. It could happen to anybody at any stage of your trading career. It's just going to happen. It's an emotional game, and sometimes you're going to cut your winners short a little bit too early. Sometimes you're going to hold on to losers. Hopefully you're cutting winners a little bit too early and not holding on to losers too much. Hopefully you're cutting the losers fine, and we'll speak about that very soon, because that's what we actually done with one of these trades that we're about to break down later on. I think that was USD JPY, but nonetheless I think this is actually going to hit take profit now, which is a shame. But again, if this happens and you do cut your losses, don't just scramble and try and get back in trades. Again, we'll have plenty of opportunities to show you exactly how, if you did miss an opportunity to get on the next sort of leg up, if there is another leg up, and how to make sure that you're actually getting a good ROI for the entry that you're actually getting. So that's been Euro GBP. That was 4.7%. Sorry, no, that was 3.8%. NZD CAD, on the other hand, was another successful trade that we had this week, and that was 4.7%. As you can see, I hit take profit. We weren't in that for take profit. We got, so let's see here. So that was about 21 pips. So yeah, we took it, I think, just before, maybe 5 pips before, so we managed to bank 4.7%. So if I could see here, 3.42. Yep, 3.8. Yep, that's right. No, it was actually 3.42 on NZD CAD. And then US dollar CAD was actually minus 2.2%. So let's just quickly break down this trade and why we actually got on this one. Had quite a nice rejection off this level. So if we just break down the price action a little bit more for what it's actually been doing recently, of course we had this squeeze and wedge pattern and a descending formation. So typically what that means is with the right confluences matched alongside it, the price action will push out of this zone and back up, and then we could maybe look to trade to the tops of the original starting point for where the price action formed. But of course we had only got about halfway, and then we started to slowly descend back down. And if we go down to the lower time frames, you'll be able to see that this level is quite a clear level. It's been respected very well, and it got respected, it got broken pretty cleanly. So typically what happens is when a level does get broken as clean as this, and it's been, you know, quite a prominent break, very decisive, and then we've showed respect of the break. We've not just came back and immediately retested. What typically happens is you will come back up and retest this. So if we just zoom in all the way in, and we go down, 1 hour is typically the entry time frame that we use to get entry signals. As you can see here, it was absolutely perfect. This is what we look for, and we'll take trades like this all day long. Was, of course, this big bearish engulfing candle, and then what happened is we've came back, tried and failed to break this high. So this is an inverted double top, right on a key level that has been tested for the first time since it had been broken. It's been respected very well. So then we took that sell position, and then ever since we had, you know, a really nice shooting star candle, which of course is telling you that the market's tried its absolute best to push up. We've opened here and we've closed all the way back down here, showing the sellers are in control. And again, if we had held on all the way, it would have hit take profit, but of course we took it out just a little bit early. But nonetheless, on those both trades was 8.5%, so we're up 8.5% at that point. And then US dollar CAD, if we go with that one right now, US dollar CAD was minus 2.2%. So again, this could have been a really nice idea, but of course it just didn't play it that way. You're going to lose a lot. It's just a matter of how much you actually losing by. Are you able to identify it halfway through the trade? Okay, it's losing, and then admit it. That's the hardest part, is admitting that you're actually losing and then cutting that short. And then also, not only that, cutting it short, admitting you're wrong, and then fighting the urge to go and try and win that money back, because you know how easy and how quick it is to win that money back. But unfortunately, the market only gives you opportunities when it wants. It doesn't give it to you because you've lost some money. I found out the hard way. So again, you need to exercise patience, and that's exactly what we did. We were already up, but if the complete reverse happened and we started off with that minus 2.2% loss, I've no doubt that we would have found that 4.7 and that 3.8 risk to reward trade that actually played out very well in our favour, because you have to have an emotionless state of mind to the wins just as well as the losses. It's so hard just to be extremely happy when you're winning, and then when you lose, just to brush it off. You have to have a balance in both areas, and that's what most people try and trick the market and try and be extremely happy when you're winning, and as soon as a couple of losing trades happen, they find it very, very difficult to actually not be emotionally unstable and start chasing the market and go into a real defeatist attitude. And it could happen very, very easily as if you're not actually practicing being controlled in your wins and your losses. So again, this was a really nice simple trade, but if we go back all the way back to the daily again, and we'll just break it down and just see what we're seeing. But looking back, I mean, of course, price action is actually starting to really slow down in the daily. So we were just planning to get just a really small US dollar CAD quick trade that would maybe bank as a 3%, depending on your account size. If you're risking 1% or 2%, you could get minimum 3%, maximum 6%. But again, it just didn't work out like that, because we do actually anticipate the dollar to be getting a little bit stronger. So that's what we're actually going to be looking for, is dollar strength. But with this was sort of like the last gasp for a sell trade in my eyes. So we're just looking at a nice entry. I can't remember where we even got in now. I think, yep, we had gotten in. We've seen this shooting star candle, and typically what happens is, this is a good example, typically what happens when you see that shooting star candle, the market will fill it, it'll come back up to retest roughly. Now this is just typically speaking, you can't take this as gospel for every single setup that you see like this, because again, the market will do whatever the market wants to do. But typically the price action will come back up, it'll fill out that wick, and then it'll make the retest back off that zone. And that's exactly why we got our entry, because you've seen here we had that touch of that zone. This was already drawn out. We've seen that excellent touch of that zone. The price action sluggishly, very slowly going to the top, trying to fill that wick. And then what happened is we've seen an engulfing candle that just completely engulfed this bullish candle that you see is rejected exactly in line with the candle wick of that shooting star. So again, more than enough confluences for us to get in that trade. But again, started going down. We thought this candle here, once it actually had, when it was actually in the market, when it was at play, we thought that was going to be perfect. We should start to roll over now, but obviously that wasn't the case. We've shot right through past that and obviously hit the stop loss. So for that we were minus 2.2%. And then USD JPY, we actually closed that for 0.02% minus. But again, as you can see, look what's happened. It seems to be going in our direction again, but again, this was one of those trades when you're trading inside a pattern like this, you don't know how well the outside trend line is going to hold price action, so you can't really have like a crazy take profit. And you can see here we're on the 1 hour, so the price action isn't really got a massive channel to be playing with, but nonetheless that would have been a nice trade, and we probably would have banked ourselves probably around 5%, 4% maybe. Yeah, definitely 4%, depending on if you're risking 2% or 1%, but you could had a nice little win. And then of course, if price actually did break through that, you know that we love to be trading price action back to the tops of where price action started in the pattern. As you can see, if you look to the left, this is what we were starting to see here. We had let's see, where did we get in? Can't remember when we got in, but I remember the whole reason for getting in this trade was, of course, we had that big push phase, and then typically what happens is you have, normally a flag pattern wouldn't be broadening like this, it would be sort of more symmetrical, but of course this one, just in my eyes, the swing points that were relevant to me had a broadening angle to them. So we were looking to eventually get buyers back in that market and eventually push up out of this pattern to the top of where it started, roughly around 109.700. So if price did break out of that pattern, it's very, very probable that we would go all the way up to the tops. So, and that would have gave us roughly about 70 pips, and you can see here the risk to reward was 6.8. So if you're risking 2%, you're making 13% off of one trade, which is incredible. But you never know. But it seems like price action might actually break through now. But again, it's good to see that the analysis is actually going in your favour, and this is going to be a common thing. Sometimes you're going to have trades mapped out perfectly. You might not have had a lot of wins, and then eventually you do get that one winning trade, and you maybe miss your entry, or price just takes your stop loss out before actually moving in the direction. So that's why we try and avoid being dumb money, and dumb money is getting in way too early, is getting in on just a couple of confluences that aren't really, they don't have much weight to them. And when I say they don't have much weight to them, they don't have much relevance. They're just feel good to put on a chart and expect price to do that. But when you actually put money into the live trade, it's a completely different story, because it's your live money. You need to make it work. And eventually, if you do not put in the proper work to actually analyze the charts properly, you will learn to analyze the charts properly through losing a lot of money. And unfortunately, for some people, that just has to happen. But nonetheless, you do get to a stage where price action, setting up the charts, going through your routine, literally becomes almost mechanic, and then eventually you get to a point where you're able to execute emotionlessly. You're able to know exactly when you should be looking at the charts, exactly when to walk away from the charts, how to get the very best risk to rewards based on entries, based on stacking confluences, what confluences have worked really well in the past, what types of confluences match with other types of confluences. And it's literally never ending, but it does get to a point where all of this really does start to make sense, and you could seamlessly pull money out of the market. But the best way to do that is you need to mitigate the risk, and you can mitigate the risk by, one, making sure that your charts are laid out properly, and two, admit you're wrong whilst you're wrong. Don't admit you're wrong after you've been wrong, and after you've been wrong is your stop loss being hit. And that's exactly what you don't want, because you can't get that money back unless you put on another trade. And trust me, it's very, very hard not to put on another trade when you've lost money. So the best possible thing we could do is avoid losing money. So that's pretty much all the trades that we went over this week so far, but there are a couple of trades that we want to go over that might be able to offer us some sort of setup. Now, this actually could be a little setup in itself, but of course we're on gold right now. We were expecting price action to come back to this level, but there is a tiny level in here that's, it's kind of hard to ignore, to be honest. It's not a typical trade that we would normally take, because we would normally try and take them, with multiple confluences, so we could stack the probability in our favour to make sure that our money is well spent. But this level here is very, very hard to ignore, because we've had that touch, we've had that touch, we've had that touch, we've pushed away and we've smashed right through it, and now we're coming back what looks like to retest. That would probably be more accurate. It looks like it's coming back now to retest. Could just be a very, very small box of consolidation and it's tricking buyers, but one could say, if you do get a nice entry signal here, if we had a nice push down and we closed all the way back up here, or maybe printed another couple of candles, we maybe could get in a buy position, because to get to this area here is going to take us some time, and of course the market's going to move quite a bit, and sometimes it could move all the way to target before it gets to these areas. It's these areas that typically we're looking for, but you have to actually be clever and understand. I mean, typically I've had setups like this on the chart hundreds of times, hundreds and hundreds and hundreds of times, and when they hit areas like this and you get the right entry signals, they're incredible. And then I've also been waiting for areas like this and then little situations like this have happened, and then it just shoots all the way up. So I guess from staring at the chart so much consistently every single day, your brain tends to record things, and then that's when you could, without actually analysing the chart, you'll just get a feeling, right, this is the right setup to be taken because of, and then once you actually dive into it, you could sort of pick out why it was that gave you that feeling of, right, money's well spent here. But sometimes without actually thinking about it, you struggle to understand it's just because you've been looking at the charts, you've seen setups like this hundreds and hundreds and hundreds of times, and your brain's recording how you feel when you're looking at these types of trades, when you've taken them, the success rates of them, even though you wouldn't be able to physically say them. If someone was to ask you, your brain's literally recorded thousands and thousands and thousands of little micro movements in the charts on the markets. So again, this could be a nice trade. It would really just come down to the fact that this is an extremely probable level to be hitting. We have been on quite a big bull run recently. But of course, price can only go up for so long. As you can see, if we look to the left, this is actually quite a big daily level. So this is why you should always go out to the higher time frames, because right now on paper you would think, right, okay, a little break and retest to this zone, that would be great. But when you take that away, you actually have noticed that we really do need to see a little bit more upside, because this is actually a big daily level that price has failed to push. We've pushed away, came back up, and now potentially this isn't a strong enough break at the level for me. It would have to be a much stronger level. It would have to be respected more, and then it would have to come back down, print a good solid entry signal, or even just come back down below and then come back down an area of interest, which would obviously be for us that area that we see on the charts right now. And then we'd be looking to take price action up. But again, this is quite a strong level, especially on the daily, so we know that the data there is significant. So if we are really to be looking to take gold higher, we would have to really see a push from this level, and then we take a nice small trade back up into this region, round about the 1880 handle, and then we could sort of analyse the chart for there. But this is the importance of always looking on the higher time frames. Gold is definitely on the watch list, but it's just, where do we get in? That is the question. And then of course, if we do get in here, we could hope to take price action up to here, and then that really will open the floodgates all the way up to 1960 over time, providing everything goes how we expect it. But not going to force anything, we're just going to watch it and keep an eye on price action over the next coming days. Again, Euro JPY, hopefully you can see what we can see here. Let's go to the daily. We've got this ascending wedge pattern. Ascending wedge pattern, price action really getting squeezed, and you can see we are firmly bullish, but we're seeing this ascending wedge pattern at the end of what looks like could be the end of a bullish run up. Now, what I think has happened here is price action's actually the market's tried to trap some buyers, because you can see the squeezing of the price action. Right, if we go back down, this is to give you the idea of what we're actually looking at. We're firmly bullish. We're in a bull trend, and now price action has been squeezed in this ascending wedge pattern. Now, what's happened is we've actually broken above this ascending wedge pattern. We've broken above this high that's been respected for the last time of the ascending wedge pattern, and then we broke above. We didn't break above convincingly. This is one of the reasons why we say we want convincing breaks, and then we want to see something like this, but much higher. like a way up here. We seen that because then that's a signal that, you know, price action has been respected. Then we come back down, but that didn't actually happen. And then look what's happened here is we created a little bit of support. We tried to push up. Then we've had a drive to high, and then a double top, and then that's when we've sank, come back down, and now we could actually be looking to take sell positions, because the fact that this has trapped some buyers, come back down below, and then hopefully we'll print some form of bearish candle. We'll be looking for a shooting star candle. It will typically look something like this, but with hopefully no wick at the bottom. An engulfing candle, an inside bar candle. So an engulfing candle is where you see this candle here is engulfed all the ones previous to it, either one before it or two before it. Or we can have a formation like this, like a doji, and then an inside bar. But an example of an inside bar is, let's try and see if we can find one quickly. So there's tweezer tops, that's a good indication that price action is going to go down again. And then an inside bar is typically this is where there's bars just on the inside of the previous bar. But we kind of want very little wicks to the upside or the downside. We want them just to be inside the actual bar. And because when the price action pushes up and pushes down, it's sort of, the more and more extreme these wicks are, the more it will show indecision. And we don't want indecision, we want definite, or as close to definite confirmation that price is going to go in the direction that we want it to go in. So again, we could be very, very soon looking for sells on Euro GPY. So mark Euro GPY, that's one that we're going to be looking at. And then a conflicting bias is Euro CHF, because that's, from what I remember, a buy position that we were looking at. But this, again, you'll be able to see here, this is what we were looking for as a buy position. We might actually create a little double top here, and then hopefully come back down to maybe anywhere in this red zone before Fibonacci one. As you can see, it's in between the 0.5 and the 0.618 Fibonacci level, so the 50% and the 61.8% region. So anywhere in here, we could print some form of entry signal. We could take price action back up to the targets around. So we could take price action, we could take targets to here. A good entry would be somewhere, down round about this region. Hopefully round about the golden fib ratio. That's typically the most common. And then have, you know, a nice candle printed in this zone here. So let's just take that off so we can see a little bit better. A nice candle printed in this zone. Maybe if we push down low but close nicely in here, then we can look to take price action to fill the top of this wick here, and then that will give us a nice entry to a trade that could potentially give us, you know, 3, 4, 5, 6% just on a nice simple break and retest, because we've understood the market, we've understood the structure, and we know where price action is going to be going. But typically when the euro's strong, the dollar's weak, and when the dollar's weak, the euro's strong. That's just typically the way it goes. So we're going to be keeping an eye on the dollar index, because we have a euro pair that we think is going to be going up, and we have another euro pair that we think is going to be going down. So typically what's happening here is, it's an interesting time for the dollar. I mean, the dollar just recently, as you can see, is moving in quite a bullish manner. We've actually pushed back above this resistance zone, which was support. It's just naked level now, being retested. Recent failed that retest, it's just crashed straight through, and now it looks like we might actually push up slightly, come back round, just push up, come back round, and then maybe break out. This could be what the dollar's actually gearing up for, so we need to be careful for that. So if the dollar was to go up, our euro bias would be short, typically speaking. Again, of course, if we are trading euro CHF, it would depend on CHF. If CHF is strong, really strong, typically this pair would go down, and if CHF was really weak, typically this pair would go up, providing everything correlates with the euro as well. But again, Euro CHF and Euro GPY, those are the only two pairs that we're really looking at right now, and we're going to be keeping an eye on the dollar index to update ourselves on the rest of the pairs in the market, because as you know, that is the main currency that the world trades in, so that has a knock-on effect to all the other pairs. So that's been the market recap. Not really too much setups to be looking at for the rest of the week, but you never know, the market might develop, and we will keep you updated on everything that we can, the Telegram group, Facebook group, Instagram pages, and everything else. And again, don't hesitate if you have any questions. There's no point sitting trading if you don't actually understand certain trades, if you don't understand how to manage the risk properly, if you don't understand how to manage it whilst it's actually live. It's a sure, fast way to lose some money, and that's exactly what you don't want to be doing, because it takes the fun out of trading and you will very, very quickly start to hate it and might even give up. So it's really not worth it. And again, you will save yourself a lot of money just by asking for help. So please feel free to reach out. And the next time we will see you will be Sunday when we do the weekly watch list. So until then, we will see you later.